Hello friends, how are you doing out there? I hope the market's treating you well, and I also hope that you've noted how the markets bounced back from their intraday lows on Wednesday. This is in line with the video that I recorded on Tuesday evening and that was uploaded on Wednesday morning, saying that Tuesday's fall was actually not to be taken as any internal problem of the Indian equity markets, but rather triggered by external factors alone. Now, to take this trading issue forward, I want to basically talk about two distinct styles of trading. And hypothetically speaking, if you've set upon yourself the target of making, say for example, 5,000 rupees a day, how to go about fulfilling that targets. You see, the markets are sometimes trending markets and sometimes they are chicken markets. That means they are stuck in a kind of a range where the prices don't really move much. Now, in markets that are trending, you would want to take a very small exposure and wait for bigger price moves. So say for example, you pick up 500 shares and you wait for a 10 rupee move, you've made your target of 5,000 rupees. In non-trending markets, which are sideways markets or chicken markets, you basically know that prices don't really move much, and therefore you have to take a big exposure, say 5,000 shares, wait for 1 rupee price move, cut your position whenever the price arrives and run. But is it actually all that simple? Is it possible that to earn this 5,000 rupees, even in a market that is trending, you might sometimes have to resort to what I call hit and run trading? Trading wherein you take a small piece of the action because the risk involved is fairly high. The answer is yes. The markets are digital beasts, and the trends are so fickle that they can change from hour to hour, sometimes even minute to minute. Now, I have for you 2 or 3 graphic points that will extrapolate what I'm trying to say. First of all, take a look at the index and the stock futures volumes chart. Now, what you can immediately realize is that these futures turnover of the indices, which is Nifty, Bank Nifty and the Nifty Financial Services Index, and on the other hand, the blue one, which is the index futures, the red one are the stock futures. These are volumes on a cumulative basis, which means that July, August and September series are taken together. What you can see is that since the last few days, the volumes on both the stock futures as well as index futures have hit a period high. The charts in question are of 20-day period. Now, when the last couple of days have seen such huge volumes, it's not really rocket science to put 2 and 2 together and see that the markets were falling, which means there is active participation on the sell side. And whenever the markets are falling like this with huge volumes, volatility or the intraday price movement, patchiness and sporadicness in price movement is extremely high. Take for example the freak price you would have seen on the Nifty futures of August series on Wednesday. That was eye-popping. At any given point in time, when you see a 200, 300, 400 point mismatch between the July and the August futures in the Nifty, it should make you sit up and take attention. Now, these are extremely volatile times, and sometimes you can see prices shoot up and down without really too much of volume being traded. Those are illiquid counters. That's another worry. The markets on certain individual stock futures are getting illiquid. It's only the indices which are witnessing a very rapid and heavy volume buying or selling. But whenever volumes dry up, and this is something that I have recorded in my earlier video, the retail trader and the markets, as well as heads up Bank Nifty traders. right? In those two videos also, I've explained to you why ingress and egress, which is entry and exit, can become difficult for you when volumes dry up. So the second chart I want you to see on your screen is the retail traders positions in the market. Now, the retail guys, when it comes to individual stock futures longs, are holding 10,13,599 net long positions, which is long minus shorts, as on Tuesday night. All right. And where index futures are concerned, they have a short position of 22,838 lots, which means the index shorts are hedging the stock longs. But do remember that the index shorts are merely 22,000 lots, whereas the individual stock futures lots are long by 10,13,000 lots. So the retail guys are very gung-ho. They've gone all out and they've basically built up huge long positions in excess of 1 million lots. Let's take a look at who's selling to the retail guys. On your chart, on your screen now, is a chart of the DIIs, the domestic investment institutions. Look at what they've done. They are holding net short positions in individual stock futures of a whopping 11,82,381 lakh lots, and the index futures are net short by 48,090 lots. So I could very clearly say that whatever the retail investor is buying, it is the DIIs who are selling to them. Let's also not forget that even though I'm recording this video on a Wednesday afternoon, by the time it's uploaded on Thursday, you would know that today is expiry day. Both monthly and weekly index option futures, index option series would be expiring, and therefore volatility is likely to be very high. In such a market, what kind of a trader would I advise you to be? I think you should be a hit and run trader. It is better to play for a rupee than wait for 10 rupees, because the counter move which can go against you can be equally large, which means you're exposing your flanks to extreme risk and adversity in terms of price mobility, which is not exactly a good thing to do. So even though the price movement is large, I would say nibble at small profits in the markets and do that multiple times, rather than trying to drink up the entire water of the well. In Hindi, there is a saying, samundar ka pura pani pina, kuएं ka pura pani pina, means drinking the entire water of the well yourself is not advisable in this market with this kind of volatility prevalent at the current times in the market. Keep nibbling, and the nibbles will itself account to a substantial amount if done well and sagaciously. Feel free to disagree in the comment section. Good, bad or ugly, whatever are your views, I welcome them with open arms. Keep them coming. And I bid goodbye to you in this video, not before reminding you to click like on this video if you agree with what you saw. Subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And refer my video to your family and friends, and help fellow like-minded investors and traders benefit from these videos. Thank you for your patience. Have a very profitable day till we meet again in my next video. This is Vijay Bhambwani signing off for now. Do take very good care of your trades and investments. Have a profitable day ahead. Bye-bye. Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.